It's November 2022, and the cryptocurrency world is about to witness something unprecedented. Sam Bankman-Fried sits in his penthouse in the Bahamas, surrounded by empty energy drink cans and trading monitors. He's built one of the most trusted names in crypto. FTX, his exchange, handles billions of dollars daily. Celebrities endorse it. Athletes wear the logo. Major League Baseball stadiums bear its name. But in just a matter of days, this empire will crumble faster than anyone thought possible. What happened next would send shockwaves through the entire financial world. Billions of dollars vanished. Millions of investors lost everything. And the man who promised to revolutionize finance became the face of one of history's greatest financial collapses. This is the story of how a math genius from MIT became crypto's biggest villain. By the time you finish watching this video, you'll understand exactly how $3 billion disappeared, why nobody saw it coming, and how one man's decisions destroyed the lives of millions. I've spent weeks diving deep into court documents, leaked recordings, and insider testimonials to bring you the complete story. What I discovered will shock you because the signs were there all along. We just weren't looking hard enough, but to understand how it all fell apart, we need to go back to where it began. The year is 2017, and cryptocurrency is exploding. Bitcoin hits record highs. New coins launch daily. Everyone wants a piece of the action, but there's one massive problem. The exchanges where people buy and sell crypto are terrible. They crash constantly. Customer service is non-existent. Trading fees are astronomical. It's like the Wild West, and nobody trusts anyone. Enter Sam Bankman-Fried, a 25-year-old former Wall Street trader with wild hair and an even wilder vision. He's already made millions through something called arbitrage trading, basically buying crypto cheap in one country and selling it expensive in another. But Sam sees something bigger. He sees an opportunity to build the first truly professional cryptocurrency exchange. Sam isn't your typical tech entrepreneur. He drives a beat-up Toyota Corolla despite being worth hundreds of millions. He sleeps on a beanbag in his office. He preaches effective altruism, claiming he'll give away 99% of his wealth to save the world. The media loves him. He's the anti-crypto bro, the responsible adult in a room full of degenerates. In 2019, he launches FTX from Hong Kong with a simple promise: make crypto trading as reliable as traditional stock trading. The platform is sleek, fast, and user-friendly. Professional traders flock to it immediately. Within months, FTX is processing billions in daily volume. Sam becomes the golden boy of cryptocurrency. But here's where the story gets interesting. FTX isn't Sam's only company. He also runs Alameda Research, a quantitative trading firm that he founded before FTX. On paper, these are separate companies. Alameda trades cryptocurrencies using sophisticated algorithms. FTX provides the platform where millions of users trade. There should be a thick wall between them, just like there is between banks and investment firms in traditional finance. That wall, as we'll discover, was made of paper. The money starts flowing in faster than anyone can count. Retail investors deposit billions onto FTX. Institutional funds park their crypto there. Even other exchanges use FTX for their own trading operations. Sam becomes crypto's most trusted figure, appearing on magazine covers and speaking at conferences worldwide. Meanwhile, Alameda Research is supposedly making incredible returns through complex trading strategies. Sam claims they're generating billions in profit through market making and arbitrage. The numbers look too good to be true, but nobody asks too many questions. After all, Sam is the math genius who figured out crypto before anyone else. The warning signs start appearing in early 2022, but they're subtle. Industry insiders notice strange patterns in how Alameda trades on FTX. Sometimes they seem to have special privileges other users don't get. Sometimes their trades happen at impossible speeds. But Sam has explanations for everything, and his reputation shields him from serious scrutiny. Then comes the partnership announcements that change everything. FTX strikes deals with major sports leagues. The naming rights to the Miami Heat's arena. Sponsorship deals with Formula One teams, celebrity endorsements from Tom Brady and Stephen Curry, Sam is spending money like it's going out of style, but where is it all coming from? Behind the scenes, something much darker is happening. Court documents would later reveal a web of secret transactions, hidden debts, and missing funds that makes Enron look like an accounting error. Sam wasn't just running two companies. He was running an elaborate shell game that would make Bernie Madoff jealous. The house of cards is about to collapse, and when it does, the fallout will be unlike anything the crypto world has ever seen. The cracks in Sam's empire first become visible in May 2022, when the cryptocurrency market experiences its worst crash in years. Bitcoin plummets from $69,000 to under $20,000. Ethereum loses 70% of its value. Smaller coins get completely obliterated. Across the industry, companies that looked invincible just months earlier start filing for bankruptcy. But FTX appears bulletproof. While competitors struggle with liquidity problems and mass layoffs, Sam's exchange keeps operating normally. Trading volumes remain high. Customer withdrawals get processed instantly. Sam even starts acquiring distressed competitors, positioning FTX as the survivor that will inherit the crypto kingdom. What nobody realizes is that Alameda Research is bleeding money. The trading firm that supposedly generated billions in profit is actually hemorrhaging cash faster than a sinking ship. Their algorithmic trading strategies, which worked brilliantly during the bull market, are failing catastrophically as prices collapse. Worse yet, they've borrowed massive amounts of money to amplify their bets, and now those loans are being called in. This is where Sam makes the decision that will destroy everything. Instead of admitting Alameda's losses and shutting down the firm, he decides to keep it alive using customer funds from FTX. It starts small, just a few million here and there to cover urgent payments. But as Alameda's losses mount, the borrowing escalates. 10 million becomes 100 million. 100 million becomes a billion. The justification is always the same. It's just temporary. Alameda will recover. The markets will bounce back. Customer funds will be repaid before anyone notices. Sam convinces himself he's not stealing. He's just managing cash flow between his companies. After all, both companies belong to him, right? By summer 2022, Alameda Research owes FTX over $8 billion. That's not a typo. $8 billion of customer money has been secretly lent to Sam's trading firm, which has lost most of it through spectacularly bad bets. The hole is so massive that even if every cryptocurrency doubled in value overnight, Alameda still couldn't pay it back. But Sam keeps up the charade. FTX continues operating as if nothing is wrong. New marketing campaigns launch. More celebrity endorsements get announced. Sam appears on podcasts discussing the future of finance while secretly knowing his company is technically bankrupt. The cognitive dissonance is staggering. Meanwhile, a small group of FTX employees starts asking uncomfortable questions. They notice discrepancies in the company's internal accounting systems. Customer deposit numbers don't match the cash on hand. When they raise concerns with management, they're told everything is fine and to focus on their own responsibilities. Some of these employees later testify that they suspected something was wrong, but felt powerless to act. Sam controlled every aspect of both companies. He made all major decisions. Anyone who pushed too hard on sensitive topics found themselves reassigned or pushed out entirely. The corporate culture discouraged dissent and rewarded blind loyalty. The end begins in October 2022, when a relatively unknown cryptocurrency news website publishes a leaked balance sheet from Alameda Research. The document shows that most of Alameda's assets consist of FTT tokens, FTX's own cryptocurrency. This is like discovering that a major investment firm's primary asset is shares of its own stock. It's a massive red flag that suggests the entire operation might be built on circular accounting. The crypto community erupts with speculation. If Alameda's wealth is mostly FTT tokens, and FTT tokens derive their value from FTX's success, then what happens if people lose confidence in FTX? The whole structure could collapse like a house of cards built on quicksand. Changpeng Zhao, the CEO of Binance and Sam's biggest competitor, decides to test the theory. He announces that Binance will sell its entire holding of FTT tokens, worth over $500 million. It's a calculated move designed to expose any weakness in FTX's financial structure. The market reacts instantly. FTT token prices start falling. Other investors begin selling their holdings too. Within hours, what started as one company dumping tokens becomes a full-scale panic. The price of FTT crashes by 30% in a single day. Sam tries to calm the markets with public statements claiming FTX has enough reserves to handle any redemptions. He posts confidently on social media about the company's strong balance sheet. But privately, he knows the truth. If enough customers try to withdraw their money simultaneously, FTX won't be able to pay them because the money is gone. The rest unfolds exactly as you'd expect from a house of cards built on lies. Customers rush to withdraw their funds. FTX can't pay them. Sam frantically calls other exchanges begging for emergency loans. But nobody wants to touch the toxic mess he's created. Within 72 hours, FTX files for bankruptcy. Sam resigns in disgrace. Alameda Research shuts down permanently. The human cost is staggering. Pension funds lose hundreds of millions. Small investors see their life savings evaporate overnight. Entire countries that stored their national reserves on FTX face economic crisis. The ripple effects spread far beyond crypto, damaging trust in digital assets for years to come. Sam Bankman-Fried, the man who promised to give away his fortune to save humanity, instead stole billions from ordinary people trying to build better lives. In March 2024, he was sentenced to 25 years in federal prison for fraud and conspiracy. The judge called it one of the largest financial crimes in American history. The FTX collapse serves as a brutal reminder that in finance, trust takes years to build and seconds to destroy. When someone promises returns that seem too good to be true, when they spend more on marketing than transparency, when they deflect questions with complexity instead of clarity, those aren't signs of genius. They're warning signs that we ignore at our own peril. The $3 billion that vanished didn't disappear into thin air. It was stolen by someone the world trusted most.